Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. In this latest episode of the Moneymakers podcast, I'm delighted to be joined by Jean Hugues de Lamaze, who is the portfolio manager of Ecofin Global Utilities and Infrastructure, an investment trust that sits in its own specialist subsector, which is infrastructure securities. So rather than investing directly into assets, it invests into companies that operate in that sector. So, Jean Hugues, this is the first time you've been on the podcast. If I can start by asking you to quickly give us the 1-minute encapsulation of what your trust does.
Sure. Good morning. So EGL, that's the ticker of Ecofin Global Utilities and Infrastructure Trust. The trust was launched in 2016, and it is a unique vehicle, as you say, Jonathan, in the sense that it invests in listed infrastructure worldwide. There's no equivalent in the trust world, I believe. And it uses both the opportunity of the asset class in itself, but also of some of the investment themes that have been developing around the companies in that universe. Characteristics of the asset class have to do with the long duration business models of infrastructure companies, so inflation pass-throughs, long-term contracts providing high degrees of predictability of future cash flows, and a specific opportunity, that's the second point, that we identify in the space related very much to the effects of the energy transition, which leads to accelerated growth, notably accelerated demand for electricity, de-risking of business models, and actually enhanced returns for all the companies that we see in our universe globally today. So those are the points which I believe explain the beauty of EGL, but also some opportunity to invest in it right now.
So I suppose I could start off with asking the obvious question. You're coming up for a 10-year track record, and you have delivered an annualized rate of return, which is around 10%, I think it's fair to say.
Yes.
So if your model is attractive, as you say it is, then why aren't there other competitors doing what you're doing?
It's a good point. Well, Ecofin specializes in this space. It's not space which necessarily has attracted a lot of competitors over the years. But I would say more importantly, infrastructure is quite often perceived as a world of private investments. So you have a lot of private equity specialists of infrastructure and quite few who focus on the listed side of the investment universe. So that's why we end up being in a space which in the investment trust world is quite special. And we have a unique vehicle. So yes, listed infrastructure is less under scrutiny than the private side. We actually believe that most of the listed infrastructure names trade at significant discounts to where they would typically be valued on the private markets. And we've seen that through a few transactions. Take private transactions over the past couple of years. Private equity specialists are paying big premiums to where listed equities investors typically value those assets.
As you say, you invest globally, so I think you have around 40% or something at the moment invested in the US listed securities and most of the rest in Europe. And if we drill down into the kind of assets that you're owning, I mean, you've talked about energy transition and you've talked about utilities. And obviously, one of the big topics of the day is, as you say, energy transition, and in particular, partly driven by AI, partly driven by other factors, the significant demand for power production and electricity in particular. That's quite a dominant theme in your portfolio, I think.
Yes, that's correct. Although obviously, as you said, we launched the trust 10 years ago, so it's not the only theme. It was pre-AI, but over the past 18 months, demand from AI data centers for electricity has been a booster to the growth profile of our companies where we invest. If you talk to the big tech firms, to Microsoft, Amazon, Nvidia even, they will tell you that probably one of the main hurdles to growth, the main challenge that they have to face is the procurement of energy and electricity to fuel their activity. So we don't invest in data centers directly, we invest in utilities that typically have started to sign long-term contracts with those tech companies. The first of this kind was actually signed in February 2024. So it's not that long ago in Pennsylvania between Amazon and a company called Talon Energy. And that was a contract signed over 17 years, but with clauses for extension of that duration. So very long-term contracts. And since then, we've seen most of the AI data center companies actually signing similar contracts with utilities in the US. It's a phenomenon which has hardly come to UK, Europe yet. We believe it's coming. 2026 will be a key year, but it's been a driving theme. And what is interesting is that it leads to overall higher demand for electricity in most OECD markets, as predicted for the next decade. We're coming out of 25 years of flat or declining electricity consumption. In the UK, we consume less electricity than 25 years ago, despite economic growth, obviously, over the period. This is bound to change. And in 10 years' time, expectations are that we will use about 50% more electricity than we do today. So massive growth potential coming from data centers, coming from electric vehicles, and overall coming from the electrification of our economies.
Also, famously, in this country, we pay higher prices for electricity than almost anybody else in Europe, and certainly more than in America. So how is this going to play out for the utilities that are benefiting with this? Are they actually going to see higher margins, or is it just simply volume growth that's going to benefit them?
No, it's going through higher prices as well, so higher returns. The reason being that we are facing a situation of scarcity of power generation resources. A lot of industrial economies have gradually phased out of nuclear, as we all know, not the UK, not France, you have a few exceptions. But you know that Germany over the past decade has entirely closed its nuclear units. The US, until a couple of years ago, were hardly investing in nuclear. And we've also phased out, in most of our economies, phased out of coal. And coal, which 15 years ago used to account for almost half of electricity generated in the UK, last year accounted for zero. So in less than 15 years, the UK has entirely phased out of coal. And nuclear and coal have been gradually replaced by solar and wind, which, as we know, are intermittent technologies. So you've been shutting down baseload technologies. Baseload, I mean those able to provide 24/7 electricity, and you have been replacing them with technologies which only provide electricity in some hours of the day or some days in the week. So very intermittent. This has generated a scarcity of supply, which has been underpinning tariff increases. Price of electricity increases. So that's exactly the phenomenon you're describing. And I believe it is favorable for the incumbent. That means that the companies that operate stable capacity today have a significant competitive advantage. That's the big comeback of nuclear, particularly in the US, where now the federal government is planning to invest big proportions into a new program for new nuclear facilities in the US. But also we have the same phenomenon in Europe. So big comeback of nuclear, which is a carbon-free baseload technology, but also with all those contracts which are being signed over the long term, overall a positive move for prices, which is very enhancing to returns for the existing generators of electricity.
So to adapt the infrastructure to cope with this extra demand, the utilities or whoever is responsible for that are going to have to invest in the grids, in the transmission mechanism and so on. There'll be a lot of capex required. Are their balance sheets in good enough shape to handle that? Or is that mainly a function of how much support they can get from governments in different regimes?
Well, a combination of a bit of everything. First of all, balance sheet, you're referring to this. Credit ratings of the companies in our universe have quite significantly improved over the past decade. And typically, the normal credit rating is around BBB+, but also we are seeing a growing number of operators in the space moving to single A credit ratings. So through notably asset disposals, we've seen actually an improvement in the balance sheet position of most of those groups. Another factor is that regulators are here to incentivize investment. As you said, we need investment in grid. We need new power generation, as I mentioned. All of that is part of the ongoing trends. So regulators and governments are here to incentivize investment, and therefore the level of gearing is much less risky area than it used to be, in the sense that this is to finance investments where you have very high degree of predictability of the future returns you're going to get, which typically are attractive. And you refer to political drive on top of regulators. Well, you've heard of the German infrastructure program, which was voted in mid-2025. That's a 700 billion euro investment program for infrastructure only. It's unprecedented. It's actually even a bit larger than the US Inflation Reduction Act. It's major. And it's going to focus on power grids, on renewables, and on transportation infrastructure, which are at the core of EGL's investment universe. We believe this is likely to be a significant factor of growth and, again, enhance returns for the space.
So if I'm an investor and I'm excited by this trend that you've described, tell me why I should invest in your trust rather than, say, investing directly into something like National Grid or SSE or something like that, which obviously those are London-listed utilities. What's the benefit of investing with you? I'm sure you're going to say your great expertise. That's obviously the starting point, but what's the case for that?
So rather than trying to convince you, I'm going to give you the actual figures, because you kindly referred to the track record of EGL over the past decade, and notably to the fact that over the past 10 years, EGL, as at the end of December, has managed to generate a 10.9% total return of its NAV per annum over the past decade. In terms of share price, you're talking about 12.9% per annum since 2016. So that is obviously decent, but it also compares favorably to what would have been a passive investment strategy in infrastructure. If you look at the S&P Global Infrastructure Index, for example, it's increased by 6.9% per annum over the period. So it is a significant additional performance that we've managed to generate through active management, but also through a combination of stocks in our portfolio, which have combined geographies, combining exposure to both North America and UK, Europe, types of business models, regulated, non-regulated, and subsegments between typically the traditional energy and electrical utilities, environmental services, transportation infra. And it's that cocktail, if you'd like, that constitutes EGL, and I believe, which represents an edge, because it's allowed us to actually spread the risks, so preserve the capital, avoid the big pitfalls, but also to gain exposure to the strongest underlying themes behind the investment universe. So active management has paid off, and I believe it will continue to do so, but also diversification to avoid individual risks. And we've seen major pitfalls in the space. It's not that easy to identify even a National Grid. National Grid took a big hit prior to its rights issue of a couple of years ago. And as soon as it announced a program to fully finance its CapEx phase, then the stock rallied significantly and it's become a very strong performer. But it hasn't been a straight line. So you need a proactive investment strategy and very selective selection of stocks in order to behave like EGL has been doing over the years, and I believe will continue to do so.
Well, just taking that number for a moment, the 10.9% total return at the NAV level since launch, if we assume that inflation has been around about 3%, that looks like about 7% real, which is pretty good, I would say, for something that's investing in what you think is utilities. That would be higher than you would normally expect, I think. So how would you say that that return has been generated? How much of that is due to gearing, either at the underlying level or at the investment trust level? Or how much of that is due to stock selection and so on? Can you analyze that for me?
So gearing, yes, has played a role, a positive role. However, it's remained limited. There is no structural gearing in EGL. We decided in 2016 to only have short-term opportunistic borrowing facilities, which we've capped at 25%, and which in average over the past decade has been just above 10%. So there's a slight positive effect of gearing in those numbers. But again, gearing has not really passed much above 10% in average over the past decade. Then the bulk actually of this outperformance or performance constitutes our stock selection and also the dividends that we are paying to our shareholders. Typically, the portfolio yield has been around 4%. It's a little bit under that at the moment. And we've invested in companies which have been able to grow the dividends by an average of 5 to 7% per annum. So if you put those two on top of one another, a dividend yield of 4 with dividends growing at around 6%, you get to the double-digit total return objective, which is very much in our mind and which is, as you highlighted, what we have generated over the years and which we remain confident we are able to generate going forward. So it is actually very much a question of stock selection, but with also dividends being a key part. The last thing I would mention about dividends is that over the past 5 years, our board has been very conscious of the need to show dividend growth and dividend support to our shareholders. And the dividend that we pay out to our shareholders on a quarterly basis has increased by an average 5% per annum over the past 5 years. And the board is committed to increasing dividend by at least the rate of inflation on an annual basis, UK inflation. Those are the components.
Essentially, your proposition, therefore, is that you are offering a respectable yield. I wouldn't say a particularly attractive yield, but you are offering some capital growth on top of that. And that might contrast a little bit with some of the individual stocks that you're investing in, which have dividends. But the dividend isn't entirely covered, is it? It's only covered, I think, around 88%, something like that, according to your last report and accounts.
Yeah, I like to say that we are always a year or a year and a half behind the full cover of the dividends. But, with the type of dividend policy that the board has put in place, again, increasing by around 5% per annum over the past 5 years, the board is ambitious and is not asking me to look for 100% cover at any point of time, because that would push me to invest in the highest dividend yielders in the space, not necessarily the highest quality names. But we are always about a year or a year and a half behind 100% cover of the dividend. You're right, at the moment it's just under 90%.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Well, let's talk about the other parts of the portfolio. We've talked about energy, infrastructure and so on. Well, first of all, give us the proportions, if you can, how you would describe the breakdown between energy, transport and other types of investment that you look at.
So the key thing to have in mind is that we build the portfolio with a bottom-up approach. Bottom-up fundamental approach. We don't prefix the allocation between the subsegments. Again, 3 subsegments: electric and gas utilities, environmental services, transportation infra. The key for us is really to balance the risk. So today we own just under 10% in environmental services and about 15%, a bit more, in transportation infra. So we have a bias towards utilities, but that's also a question of number of names and opportunities. In transportation infrastructure, there's not so much you can identify in the listed infrastructure world. One example, airports. You only have 10 listed airports in OECD markets. We own 2 of them, but it's difficult to go well beyond. We find the airports subsegment clearly undervalued. It's interesting to see that those companies in listed markets trade at an average of around 9.5 times EV/EBITDA. But when you take the 10 most recent transactions in the private equity world of airports in OECD economies, they have averaged above 19 times EV/EBITDA. So 9.5 times for listed airports and above 19 times for private airports. So this is the type of valuation gap which we find interesting to focus on. It's an anomaly, but obviously there's not so many opportunities to invest in it in listed airports. So the breakdown of sub-segments is key, but it's going to be limited by the investment universe itself. What I would say, maybe one additional point to your question, Jonathan, is to highlight that about a third of the portfolio is invested in pure regulated utilities. And that's important because those companies give, again, a lot of capital preservation characteristic to the portfolio. They act a little bit more like bond proxies, but the interest rate spiking phase is largely behind us. 21 to 2023 were actually challenging in that respect. This is a time period during which we underweighted regulated utilities because of the spiking interest rate phenomenon during those years. With interest rates plateauing worldwide, we've increased a bit our exposure to regulated utilities, accounting for a third of the portfolio today. So it's going to be a mix of types of business models. That's the key.
But you adjust that over time. So, as you say, in response to the signals from the bond market and the equity markets.
Correct.
So if we look ahead then over the next couple of years, obviously a lot of people expect that short-dated interest rates are going to come down a little bit. But at the moment, long-dated interest rates are remaining pretty firm, rising in some places. Is that net positive or negative for the kind of securities that you're investing in? And secondly, what are the major risks around that and around the environment that you can see over the next couple of years? What could go wrong from this rather rosy picture that you've painted so far?
Well, I don't think I'm overly optimistic on interest rates. More importantly, I'm not trying to have a directional positioning of the portfolio depending on interest rates. We obviously allow ourselves to be nimble, but again, it's more a result of stock selection than top-down views. Obviously, we pay attention to interest rates, which are one of the key driving factors behind the relative performance of utilities and infrastructure names. But interestingly, the real effect on the economics and the financials of those companies, real effects of interest rate is much more limited than perceived by the market. In periods of steepening yield curves, utilities underperform. And when you have a flattening of the yield curve, typically they start to behave better. But it's more a question of flows in the markets. So it's much more a criteria for generalist investors than for us as specialists. And obviously, I referred to the 2021 to 23 phase, during which long-term treasury yields in the US spiked from 1% to 5%, pretty much in a straight line, typically a major headwind. Well, as you see from the track record of EGL, we have managed to navigate through that because we can adapt the portfolio to reduce the exposure to that phenomenon. And we focus over that period on companies which had very strong inflation pass-throughs. The real matter was about inflation during those years. And we have great ways to offset inflation, either through regulatory frameworks which allow pass-throughs, like you have in the UK, like we see in countries like Italy, avoiding the regulatory frameworks where there was no pass-throughs, like Spain, for example. Spain was a much riskier geography to invest in those types of regulated names during the phase of spiking and steepening yield curves. So we adapt to that. And then when I was saying that the interest rates were plateauing today, I'm not necessarily basing the portfolio on an optimistic scenario of declining interest rates, but I have exposure to companies which in the end have very long-term borrowing facilities, long-term debt structures, and which are in fact very hardly exposed to short-term fluctuations in interest rates. So it's more a question of insulating ourselves against the risk than trying to be opportunistic in gaining from an interest rate trend, which we may all have an opinion on. But, I don't consider this is where Ecofin has an edge compared to any investor. Our edge is in analyzing the typical risk profile of the companies we invested in utilities and infrastructure. That's the only thing we do.
I get that. So let's just talk then about the share price performance of your trust.
Yes.
You obviously mentioned that the share price total return has been about 2% higher than the NAV total return since launch. But that experience of yours has been basically a bit of a roller coaster in the sense that I think you traded at a premium, you issued some shares, then you've traded at a discount, which got quite wide at one point, and now the discount is coming back in again. And it is fair to say, I think, that if you compare your trust, your discount, I think at the moment is somewhere around 8 or 9%. And that is substantially lower than any of the infrastructure trusts that are renewable infrastructure trusts, for example, that are investing in assets rather than in the securities. So the discount is coming in. The trust has been buying back shares. I think you're still net more in issue than you had when you launched because you issued quite a few and now they've come back a fair way, but not the whole way.
Correct.
And you have had an activist investor on your shareholder register. Saba Capital declared an interest back in August 24, I think it was. So you're the portfolio manager, of course. Your job is to manage a portfolio. But as far as doing that is concerned, how far does the discount drive the way that you manage the portfolio?
To be honest, it doesn't much. What I would say is that the discount is one of the most frustrating part of my job because that's something which I have no grasp on. I don't control it as the manager. So it's in the hands of our shareholders. And what I would say is that for years, when we launched the trust in 2016, we were trading at a significant discount. We needed to win the credibility and the trust from our shareholders. And during 2020 to mid 2023, the trust EGL moved to a premium. And as you said, we managed to issue shares at the time. Then we definitely moved back to a discount in 2023. And I believe the best approach there was the approach which was adopted by our board, which was to buy back shares. Buy back shares to show our confidence in the strategy, which we've been doing, therefore, in a very systematic way over the past 2.5 years. And that's, I guess, what we need to do. It's paid off to some extent, but my job in the meantime has really been to focus on performance. And I believe this is the winning formula at some point. Some buybacks to show your degree of conviction and consistent performance delivery, which is really the part I'm obsessed about. So yes, we've had an activist in the capital. I think in the latest register, if I'm correct, Saba was declaring above 5%, 5.4%, I believe. And, if they saw an opportunity and a discount which was double digit for some time, I understand that. Because to me, it's quite an anomaly that when I see the valuations, absolute and relative, in terms of P of my stocks trading on historic lows, when I see valuation gaps like the one I referred to in airports, but we see that in many subsegments of the infrastructure world between listed and private assets, adding to what I consider to an existing fundamental discount for the assets, adding a discount to the trust itself is kind of the double opportunity for an investor. And I still sense it as an anomaly. But again, that's not something I control. My job is, as you say, to focus on performance. And I believe at some point, the credibility of a consistent and solid performance has to be the winning formula. But buybacks have played a role, of course, and the board is committed to continuing to do so as long as the discount is what it is.
The market capitalization of the trust is around 220 million, I think, as of today, the day we're speaking. And a lot of people say, well, that's now too small for an investment trust to carry on at that size. It's too small for some of the bigger wealth management houses. And you have been buying back shares, and some of those shares perhaps have come from wealth managers or other institutions. I don't know. We don't have the details, I don't think, on who they are. So 2 questions arise from that. One is, do you share that perspective? And secondly, perhaps reversing that round, how much capacity for growth in the size of the trust do you actually see, given there are some constraints around the available opportunity set, for example, that you mentioned earlier, in terms of the availability of listed instruments that meet your criteria and you find attractive?
Yes, I share the view that the trust is too small. But, there are only two ways to grow it, performance and issuances. And to issue shares, it needs to move back to a premium. So those two are kind of interrelated. Performance, again, has to remain solid and consistent. And I believe at some point it will lead to premium. So yeah, I share the view that it should be larger. And especially because, to answer the second part of your question, I believe we are far from having some liquidity constraints for the strategy. We invest in large caps. It's a very large universe, which we estimate at something like over $6 trillion worldwide in our space, with hundreds of names. So it is a very scalable strategy. I like to say that it's a strategy on which we could run several billions without facing a significant constraint related to the liquidity of the names which are inside our portfolio. So it's a very scalable strategy. We need to grow the trust. And I'm doing my best, again, to deliver this growth through performance. One, because it grows the size of the portfolio when it performs, like it did over the past few years. But also because that's at some point, I hope, the way to go back to a premium where we'll be in a position to issue.
If you are correct that the kind of companies you're investing in are effectively trading at a discount or they're undervalued compared to unlisted private equity transactions, that might make your portfolio attractive to some private equity investor, you might think.
You might think that, but in fact, we've seen quite few only transactions, takeout transactions in the infrastructure world. Last year, 2025, there was one large size transaction, which was the take private deal of Energex in Canada. Energex was a Canadian renewable developer, which was taken out by Caisse de dépôt du Québec, which took it private. The valuation terms were striking. Caisse de dépôt du Québec paid an 80% premium to the average share price of Energex. 80. And I think they very much knew what they were doing. One, because they are a very solid actor in private equity world. Two, because it was their geography. They were buying Energex, which was next door. So they knew exactly what they were buying. And they paid an 80% premium. So unless you think that those private equity specialists are out of their mind when they pay those prices, which I believe is clearly not the case, you have to deduct that those listed infrastructure assets are trading on much too low valuation terms. So that's what is behind my conviction level when I invest in the space. I think valuations are too low, but we've seen very few transactions yet. I think you need a couple of maybe more emblematic takeout trades to really build that momentum of re-rating of the listed infrastructure asset class as opposed to private. So do I see it as a risk for me? Well, no, I see it as an opportunity. Again, the more active private equity players will be in the space of listed infrastructure, the better it will be for the whole space, I believe, because listed equity investors will realize that they tend to undervalue those assets, which offer, again, very solid long-term, long-duration characteristics with capital preservation and structural growth behind them.
So you're kind of saying in a way that there's been a bit of a market failure here. In other words, the market has got this wrong.
No, the market is never wrong, but...
The market is never wrong, exactly. But in this case, they're distracted by other things, maybe. Perhaps that's the best way to put it.
Well, the market is volatile. And again, when we've seen steepening yield curves over the past few years, inflation, this was a deterrent for listed equity investors. They were much more attracted by tech or more cyclical sectors in those phases than interested in valuing long duration, almost somewhat boring sectors like infrastructure or utilities. So there's been this phenomenon. Then obviously geopolitical risks, all of that generates volatility on the market. I believe private equity investors tend to be better at sensing the beauty of long duration contracts and business models. So that's why. So I don't think the markets are wrong. I think the markets had other things to think about than focus on this. And maybe it's time for me to mention something I referred to briefly upfront in our conversation, Jonathan, which is the de-risking of that investment universe of utilities in particular in the past decade, which I believe is overlooked by listed investors today. A lot of them have a dual image of utilities. They think it's a bond proxy, so you only invest in utilities when interest rates go down. And again, this was proved wrong if you look at the track record of EGL over the past few years. And they also see the space as very much commodity driven. And it's true that 15 years ago, we've analyzed a sample of the 10 largest utilities groups in UK, Europe. 15 years ago, about half of their operating profits were stemming from conventional power generation, largely a merchant business. So generating good returns in years when commodity prices were up and bad returns when they were coming down. And you know, the world is paying a lot of attention to commodity prices today, saying that if you have some peace agreement in Ukraine, which we all hope for, maybe you'll see a drop in some of those commodity prices. In fact, what is interesting in our analysis is that the proportion of operating profits for those largest groups stemming from conventional commodity-driven businesses has shrunk dramatically. It's only 10% today. It was close to 50% 15 years ago. It's only about 10% for that same sample of the 10 largest utilities in UK, Europe. And what has replaced this is a combination of regulated activities or fully contracted businesses through power purchase agreements, PPAs as they're called. And power purchase agreements are exactly the ones which AI companies are signing with utilities today. So this is a proportion which keeps on increasing. So 80% of the operating profits of those companies is now fully predictable. You precisely know the returns that you're going to generate on each of those contracts, each of those regulated activities. So that represents, from my perspective, a dramatic de-risking of the traditional business model of utilities, while valuations are what they used to be 15 years ago, when actually the space was much more dependent on external factors, much less predictable. So we can even argue for a re-rating of the space, which is yet to happen. So no, the market is not wrong, but the market, I don't think, has fully accounted for those structural phenomena which you see as a specialist, not necessarily if you're a generalist investor.
So I guess that means that the major risk then that remains is about the credit risk, if you like, or the credit rating of those who are actually providing these guaranteed payments for long duration assets, whether that's governments or AI developers, whoever it might be.
Financeability is key. But again, I mentioned National Grid. You could mention the same for SSE, Scottish and Southern. The day when they announced some capital issuance deal and transaction, the share price starts to rally because then the financing of the capex is in the bag. So financeability is a key factor, and credit rating, you're absolutely right. We're paying a lot of attention to that, as I mentioned up front.
Well, I think we've given quite a good trip round the investment trust. I guess I just finished then where I started with the question is, do you think you are capable of generating a double-digit return over the next 10 years?
Yes. And it's not about myself. It's not about myself. It's about the beauty that we see in the fundamentals and the outlook of the space. It's only getting better. Over the past 12 months, and this has been an underperforming asset class, but over the past 12 months, companies in the US and in UK, Europe have only been raising their earnings guidance by about 10% over the past 12 months. It's massive. It's very unusual. And those companies yet have to perform. Some trade on 10, 12 times PE, when I believe they should trade at probably almost 50% higher PE. And in the US, a lot of utilities trade on 18, 20 times, when in Europe, we find a lot at 10, 12 times. So you've got that discrepancy between very strong fundamental outlook, structural growth, enhanced returns, de-risking phenomenons, yet to be valued by the market. So yeah, I believe the space is in a position to provide double-digit total return for shareholders, as long as you avoid the pitfalls. So being a specialist, I guess, helps in identifying the winners and the losers to avoid them in that space.
And then a final sort of coda to that, just as about the currency exposure you have, because obviously you're investing in the US, you're investing in Europe, you're investing in the UK. What is your currency exposure, underlying currency exposure, and how do you manage that, if at all?
So we do not hedge currencies, very much at the request of our shareholders. We provide full transparency on the geographical and currency exposure. Clearly, this is a sterling-based investment trust, but close to 90% of our portfolio is invested outside the sterling zone. So that gives you a good idea. You've got about 40% of the portfolio in the US dollar zone, about 40% in the Eurozone, and each shareholder is able to organize its own currency hedging. We don't do it. We would not add any particular value in doing so. But clearly, this is the way we provide full transparency and the ability for our shareholders to hedge themselves if they want.
Very good. So on that note, I'd like to thank you for taking part in the podcast, and we'll look forward to seeing how well the trust continues to perform.
Thank you, Jonathan.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.